The Strait of Hormuz is still largely closed. It has been for months.
And on Tuesday, Brent crude fell about 5.5%.
That is a third consecutive session lower.
And the thing that supposedly caused it was the largest package of Iran sanctions in years, announced on Monday.
So the sanctions landed, and oil fell.
Which sounds like a contradiction until you look at what the market is actually pricing. It is not pricing the sanctions. It is pricing something that has not happened yet. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
S&P 500, 7,677.28, up 0.32%.
Dow 53,577, up 0.03. Nasdaq Composite 26,151, up 0.66. Russell 2000, 3,010, up 1,000.
VIX 1545, down 2.52%.
Semiconductors recovered, up 1.56%.
And the volume tells you how much conviction was behind any of it. The S&P traded 45% of its median. The tracking fund, 61%.
Under half of normal. So this was a quiet, thin session, which matters because the two big moves underneath it were anything but quiet.
And the 10-year fell for a third consecutive session to 4.64%. The 30-year, 5.7%.
So let's rank the reasons, because they are not equally well evidenced.
First, and this is the one dated to Tuesday, Pakistan's army chief met Iranian leadership in Tehran, pressing for a reopening of Hormuz and for de-escalation between the United States and Iran.
That is the named dated catalyst. It is a secondary source report, not a filing, and it is labeled that way on screen.
Second, the cure period. When the Treasury Secretary announced the sanctions on Monday, he explicitly did not impose the new secondary measures. A cure period defers enforcement.
Which means no barrel actually comes off the market in the near term. The supply picture on Tuesday is identical to the supply picture last week.
Third, OPEC Plus raised output for a fifth consecutive month by 188,000 barrels a day.
And fourth, the International Energy Agency cut its 2026 demand forecast by 1.6 million barrels a day, back on the 12th.
So, talks, deferred enforcement, more supply, less demand. None of those is a barrel returning to the market today.
And that is the fragile part. Hormuz has not reopened. There is no deal. There are talks, and the strait is still largely shut.
So the market is not pricing a reopening. It is pricing the possibility of one, and it paid about 5.5% for that on Tuesday.
Our read, not consensus. An expectation priced ahead of the event. If those Tehran talks stall, none of the other three reasons holds this on its own.
Expectations unprice faster than they price.
And you can see how one-directional Tuesday was inside the energy names because our own measurements are unusually stark here.
The energy sector fund fell 1.66%, and it closed at 2.7% of its daily range.
Which means it finished within a hair of the lowest price it traded all session.
Occidental down 2.83, closing at 4% of its range. Chevron down 1.58, closing at 4.5. Exxon down 2.08 on 125% of its median volume, closing at 6.9%.
Schlumberger down 1.31, closing at 17%.
So the whole complex was sold steadily into the bell, and Exxon on above normal volume. That is not drift. That is a sector being repriced in one direction for an entire session.
Now, a callback. Because this is the mirror image of something we measured on Monday.
On Monday, Iran blacklisted 45 tankers, and the tanker equities rose while crude fell, because restricting non-compliant transits made compliant tonnage more valuable.
On Tuesday, with de-escalation talk in the air, that reversed.
Frontline down 1.34% on 165% of its median volume. TK down 2.15 on 111%.
And DHT down 2.79 on 129%, closing at 8% of its range. Scorpio down 1.25, closing at 10%.
Elevated volume, closing near the lows, across the group.
Which is a neat demonstration of the mechanism working in reverse. The value of a compliant ship depends on how many ships are excluded. Talk about reopening the strait, and that scarcity starts to erode before a single vessel moves.
Then the release that almost nobody led with, and it is the most interesting number of the day.
The Conference Board's Consumer Confidence Index for August came in at 89.4, down from 90.2. That is a 7-month low.
But the headline is not the story. The internals are.
The Present Situation Index, how consumers rate conditions right now, rose 6.8 points to 121.2.
And the Expectations Index, how they see the next 6 months, fell 5.8 points to 68.2.
Anything below 80 on that expectations measure has historically signaled recession risk within the year.
And the third number ties it together. Households now expect inflation to run at 5.8% over the coming year, up from 5.6%.
So read those three together. Conditions right now are better. The future is materially worse, and they expect higher prices.
That is a stagflationary expectations print, and it is the dated reason the long end fell for a third day.
And here is what we think is the most undercovered thing that happened on Tuesday, because it is the same print priced.
Gold itself was up only 0.32%, a nothing move on the face of it.
Except it traded 142% of its median volume, and it closed at 98.8% of its daily range.
Heavy volume, finishing at the very top of the day.
And the miners were emphatic. The miners fund up 1.91% on 128% of volume, closing at 96% of its range.
Anglo Gold up 2.42, closing at 100% of its range. Kinross up 1.52, also at 100%.
Agnico up 2.85, closing at 98. Newmont up 250 at 97. Wheaton up 2.2 on 133% of volume, closing at 98.
So every one of them finished at or within 3% of its high, on above normal volume.
Our read. That is inflation expectations moving from a survey into a position. The confidence report said households expect 5.8%, and gold was bought all day and held into the close.
And then the other big move, which went the opposite way to Monday.
Centris up 9.17%. Oklo up 11.54. Bloom Energy up 6.58. NewScale up 8.40. The Uranium Fund up 5.36. Cameco up 4.59.
And the volume says it was bought, not squeezed. Centris on 110% of median, closing at 98% of its range. NewScale on 176%. Oklo on 159%, closing at 88%.
The Uranium Fund on 143%. Cameco on 110%.
Elevated volume across the group, everything closing near its high.
Now, the explanation being offered is an oversold bounce after Monday's sell-off, and there is a dated source calling it exactly that.
No new contract or policy landed on Tuesday. We looked, and there isn't one. So we are not going to invent a catalyst.
Except a pure bounce does not quite fit what the numbers do, and this is worth 30 seconds.
Cameco fell 0.23% on Monday. 0.23, and then it rose 4.59% on Tuesday.
The Uranium Fund fell 0.82 and rose 5.36.
You cannot call that a recovery of Monday's losses. There were barely any losses to recover.
And when you measure the whole complex against Friday's close before any of this started, every single name is now higher than it was.
Bloom up 7.94% versus Friday. Oklo up 5.18. The Uranium Fund up 4.49. NewScale up 4.36. Cameco up 4.34. Centris up 3.83.
So this is not the market putting something back where it found it. Over 2 sessions, the entire complex was re-rated upward.
Now, the part that makes this more than a price move, because there is a real structural argument here.
Centris is the only domestic American enricher of high-assay, low-enriched uranium, the fuel most of the advanced reactor designs need.
And it has been building that position. A supply agreement with X Energy signed on the 6th of August and a $900 million Department of Energy award in July under a $2.7 billion program.
The logic is straightforward. Sanctions that push Russian and Iranian proximate enrichment further out of bounds make a domestic enricher more valuable, not less.
And the underlying arithmetic is genuinely tight. Reactor demand is around 190 million pounds of uranium oxide a year against mine supply of about 135 million, with utilities undercontracted. Spot is near $89.55 a pound, and long-term contracts are above 100.
Now the caveat, because the evidence usually offered for this does not survive a second day.
On Tuesday alone, Centris at 9.17% looks like exactly double Kimiko at 4.59. Enricher Premium, minor beta.
But measured from Friday, Centris is up 3.83% and Kimiko is up 4.34%. Over the 2 sessions, the minor slightly beat the Enricher.
Centris only looks like the leader because it fell further on Monday. The structural argument for enrichment may well be right, but Tuesday's price move is not the evidence for it.
This whole week is pointed at one thing.
Chairwarsh's position, stated at the July 29th press conference, is that rising long-term yields have tightened financial conditions without the Fed having to move. He called that the beginning of the story, not the end of the story.
The long end has been doing his tightening for him.
And the long end has now fallen 3 sessions running, on soft confidence, on collapsing oil, and on unconfirmed speculation about Treasury buybacks.
So his premise is eroding in the week he has to stand up and speak to it. Jackson Hole runs Thursday to Saturday, and his keynote is Friday.
2 things to clear up before then. He has not abandoned the 2% target. He reaffirmed it, and that is confirmed by several independent accounts.
And this is a policy conflict, not a plot. The Treasury leaning against the long end while the Fed chair says he wants it high is 2 mandates pulling opposite ways. There is no evidence of anything more than that.
And before Friday, there is Wednesday, which carries an unusual amount.
In the morning, the July inflation report and the weekly crude inventory report land together.
That crude number matters more than usual because the figure people have been quoting, a 17.4 million barrel build, is from the week ending the 7th of August. The current one has not been published yet.
And after the close, NVIDIA, Salesforce, and CrowdStrike all report.
NVIDIA closed Tuesday at $213.05, up 2.19% after 7 consecutive declines into this week.
Its own guidance is $91 billion. Consensus is 91 to 92.3. Earnings consensus is 209 a share, with a whisper number around 212 to 217. And one bank raised its target to 330 on Tuesday.
The options market is pricing a move of about 5.4% either way.
And there is one positioning detail that argues for a contained reaction. Goldman's prime brokerage data has net leverage at a 1-year low.
Which cuts both ways, and that is the point. Light positioning means less forced selling if they miss, and less fuel for a squeeze if they beat.
One habit before we close, and it is the 4th day running it has been worth having.
Oil was blamed on rising yields, and the 10-year fell. Oil was said to have spiked on the sanctions, and Brent fell for a 3rd straight session. A nuclear rally was attributed to a contract that does not exist on that date. Check that the thing in explanation blames actually moved.
As for what to watch, on oil, it is whether the Tehran talks produce anything, because the decline is priced on an expectation, not an event.
On Wednesday, it is whether NVIDIA's customers are still accelerating rather than the headline number itself. Positioning is already light.
And on Friday, it is whether Chair Warsh tells you how he reacts rather than what he forecasts. His stated approach leans on the long end doing the work, and the long end has spent 3 sessions going the other way.
A quiet tape on half the usual volume, sitting in front of a very loud 48 hours. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.